Recessions are moments when fear dominates the global economy, when markets shrink, businesses contract, and millions of people lose confidence in the future. Yet hidden beneath the panic lies a pattern as old as capitalism itself. Every economic downturn reshapes wealth, redistributes power, and creates opportunities that only a small fraction of people recognize in time. The question has never been whether recessions will occur, because history shows they always do, but rather who understands how to position themselves so that the period of contraction becomes the foundation for future financial expansion. Economic cycles function like tides. Money flows in, confidence builds, spending rises, and assets inflate. Then something shifts, sometimes a slow structural breakdown, sometimes a sudden shock. Liquidity tightens, borrowers struggle, consumers hesitate, investors retreat. What follows seems destructive on the surface, but underneath, the recession pushes weak businesses to collapse, overpriced assets to return to fair value, and markets to reset in ways that open space for new winners. The majority experience this reset as pain, but a strategic minority treat it as the moment they have been waiting for. Profiting from a recession begins with understanding what actually changes during downturns. Prices fall because people stop buying. Businesses lay off workers because revenue drops. Investors sell assets to protect liquidity. Governments intervene, but often too late to prevent the initial damage. This collective pullback drives asset classes into oversold territory, creating distortions between real value and perceived value. Those distortions are the fertile ground for long-term gains. When an economic system is under stress, capital behaves differently. It flees risky environments, concentrates around safe havens, and waits for signals. The individuals or institutions who can recognize these signals earlier than the crowd become the ones who accumulate the greatest advantages. Every recession exposes three main categories of opportunity: undervalued assets, distressed businesses, and behavioral mispricing. Undervalued assets are the most visible. Stock markets tend to fall sharply as investors panic, selling positions not based on fundamentals, but emotion. High-quality companies with strong cash flow, durable demand, and proven management can lose 30-50% of their market value simply because the surrounding environment feels uncertain. For strategic investors, these moments are equivalent to buying prime real estate during a temporary storm. The building remains the same, only the weather has changed. Distressed businesses represent another channel. During recessions, companies with weak balance sheets face liquidity shortages. They may struggle to refinance debt, meet operational expenses, or survive prolonged drops in demand. Investors with cash reserves, private equity firms, wealthy individuals, or well-prepared entrepreneurs can acquire these businesses at steep discounts. They are not buying the crisis, they are buying the recovery. Historically, many of the most profitable acquisitions have happened during recession years, when valuations hit their lowest points and competitors are too fearful to take risks. Behavioral mispricing is perhaps the most powerful opportunity because it is driven by human psychology rather than economic fundamentals. Fear amplifies small problems into large ones. Rumors drive decisions faster than data. Entire sectors can be temporarily abandoned, even if the long-term future remains strong. When investors overreact, the resulting price movements create asymmetric scenarios where the potential upside far outweighs the downside risk. This is the foundation of contrarian investing, a philosophy built on the idea that wealth grows fastest when moving in the opposite direction of the crowd. Profiting from a recession does not start at the moment the crisis begins. It starts with preparation. Liquidity is the lifeblood of opportunity. The individuals who thrive during downturns are rarely the ones scrambling to raise cash after markets collapse. They are the ones who entered the recession with liquidity already secured. This liquidity may come from savings, low leverage, or passive income streams that continue even during economic contraction. The purpose of liquidity is not simply financial safety, it is strategic flexibility. During recessions, prices drop rapidly. Tight credit limits the buying power of average consumers, while distressed sellers create urgency. Those who can move quickly without waiting for banks or partners can secure the best opportunities before the broader market recovers. Cash is not merely a defensive asset during downturns, it becomes an offensive weapon. Another critical element of profiting during recessions is the ability to separate noise from signal. Economic news becomes more dramatic during downturns. Predictions multiply. Commentators emphasize collapse rather than recovery. Markets swing violently in response to headlines rather than data. In this environment, emotional decision-making destroys wealth faster than economic conditions themselves. The individuals who gain the most are those who adopt a long-term perspective, examining which industries will rebound strongest once the recession ends. History shows that sectors essential to daily life, such as utilities, healthcare, consumer staples, and transportation, retain long-term stability even when short-term demand fluctuates. Similarly, technology, energy, and critical infrastructure often emerge from recessions, with accelerated growth because crises reveal inefficiencies that spark innovation and policy change. Identifying these patterns allows investors to focus not on the chaos of the present, but on the trajectory that follows. Real estate is another area where recessions create unusual advantages. Property prices fall when financing becomes difficult or when homeowners face economic strain. Investors with capital can acquire properties below market value, benefiting from reduced competition. As the economy recovers, both prices and rental demand typically rise, creating long-term appreciation and cash flow potential. The key is evaluating fundamentals such as location, demand trends, and structural quality rather than focusing solely on short-term market fear. Entrepreneurship also thrives in recessions. Many of the world's most successful companies began during downturns because recessions eliminate weaker competitors, reduce operating costs, and expand the talent pool as skilled workers seek new opportunities. Consumer behavior shifts during crises, creating demand for new solutions, affordable alternatives, and innovative services. Entrepreneurs who identify these shifts early can build companies that grow rapidly when the broader economy recovers. But profiting from a recession requires discipline. It requires resisting the instinct to sell and panic, avoiding over-leveraged positions, and maintaining a strategic mindset while others focus on survival. The difference between those who lose everything and those who build generational wealth lies not in predicting the exact timing of a recession, but in preparing for its inevitability. Throughout history, from the Great Depression to the 2008 financial crisis, patterns remained consistent. Those who panic follow the cycle downward. Those who prepare accumulate assets when prices are lowest. Those who remain patient allow compounding to work in their favor when recovery begins. Every recession resets the playing field, but only those who study the mechanics of downturns recognize the advantage in the reset. As economic turbulence grows, the path to profit becomes clearer for those who understand the dynamics of contraction and recovery. Capital shifts. Opportunities appear. Markets transition from fear to resilience. Those positioned with liquidity, knowledge, and strategy are able to step into moments where others are stepping back. This is the difference between waiting for recovery and building wealth during recovery. Part 1 establishes the foundation for navigating downturns, revealing how recessions reshape the economy and why they create rare opportunities for strategic investors, disciplined savers, and forward-thinking entrepreneurs. The remaining sections expand this framework, detailing the practical steps, investment strategies, sector-specific insights, and actionable approaches that transform a recession from a threat into an advantage. During every recession, as fear spreads and uncertainty dominates the news cycle, something unusual happens beneath the surface. An invisible transfer of wealth begins. While millions panic, cut spending, and withdraw from opportunities, a smaller group quietly positions themselves to benefit from the shift. They do not rely on luck or timing. They rely on understanding how recessions reshape behavior, capital markets, and long-term value creation. As conditions tighten, these individuals recognize patterns repeating across history. They observe how asset prices become disconnected from fundamentals, how businesses with weak balance sheets crumble under pressure, and how investors driven by emotion sell not because they want to, but because circumstances force their hands. This is the moment disciplined thinkers prepare for, knowing that economic contractions don't just destroy wealth, they redistribute it. The early stages of a recession introduce contradictions that confuse the average person. Prices of daily essentials continue rising while the value of major assets declines. Job losses rise even as companies still report profits. Governments announce stimulus packages while central banks tighten monetary policy. These conflicts cause many people to freeze, unsure of what any decision will lead to. But those who study recessions understand that this chaos reveals where the imbalance lies. Recessions expose the sectors that grew artificially fast, the companies that relied on borrowed money to survive, and the industries whose revenues were inflated by temporary trends. When these weaknesses become visible, the correction follows. And in these corrections, long-term opportunities emerge. Every recession begins by accelerating something that was already happening in the background. Consumer spending shifts. Technology replaces outdated jobs. Businesses consolidate. Debt becomes more expensive. If someone identifies the direction of these shifts early, they know exactly where the next wave of growth will begin. Profiting from a recession isn't about predicting the bottom or timing the exact moment of recovery. It's about recognizing which economic forces are permanent and which are temporary. When the noise clears and the panic subsides, the market always rewards those positioned where the world is heading, not where it used to be. One of the clearest ways people profit from recessions is by deploying capital into undervalued assets. When fear rises, prices fall quickly, often too quickly, creating opportunities that only appear during economic downturns. Stocks of strong companies get discounted heavily, not because their long-term value has changed, but because investors need cash. Real estate markets face sudden declines as sellers rush to exit. Commodities move erratically as supply chains contract. In these moments, the disciplined investor stands apart. Instead of reacting to panic, they examine fundamentals. They ask whether a business still generates strong cash flow, whether a property sits in a growing region, or whether a sector will rebound once the downturn ends. This calm analysis allows them to acquire high-quality assets at prices impossible to find during stable years. But recession opportunities extend far beyond buying discounts. One of the most overlooked ways to profit during downturns is by increasing skills that directly boost income. A recession rearranges the job market. Companies cut unnecessary roles, but aggressively hire for positions essential to survival: technology, logistics, cybersecurity, financial planning, data analysis. During difficult periods, people willing to invest in new skills gain bargaining power. Employers prioritize efficiency. And efficiency comes from workers who can perform tasks traditional teams once required multiple people to complete. This shift allows those who upskill to negotiate higher pay, secure remote roles, or build new income streams that continue long after the economy recovers. Another powerful recession strategy is building a high-demand business designed specifically for downturn behavior. When people cut expenses, they shift spending toward needs rather than wants. Services like repairs, maintenance, essential goods, budgeting tools, debt assistance, and cost-saving solutions grow rapidly. Even luxury markets can thrive if they reposition themselves to highlight quality and long-term value rather than indulgence. Recessions reward businesses that solve real problems. If someone identifies a growing pain point, rising debt, uncertainty about job security, challenges with food or energy costs, they can design a service or product that addresses it directly. Many of today's most successful companies were born during recessions, precisely because economic pressure forces innovation. Debt restructuring is another avenue people use to profit during downturns. When interest rates shift and lenders become stricter, individuals and businesses with excessive debt face hardship. But those who understand how credit markets work can refinance, consolidate, or renegotiate terms in ways that improve their long-term financial stability. Lower debt burdens increase flexibility, allowing them to make investments others can't. Sometimes, simply freeing up a monthly cash flow creates enough opportunity to shift funds toward markets that will rebound later. This approach doesn't require enormous capital, only understanding, discipline, and timing. Recessions also reshape consumer psychology in predictable ways. People become more cautious, more selective, and more price-sensitive. They rely on trusted brands and cut risky spending. Investors who understand this psychology avoid hype-driven trends and instead look at sectors connected to stability: healthcare, utilities, essential technology, energy infrastructure. These sectors rarely collapse even during deep downturns, making them ideal places to store value while waiting for recovery. When markets stabilize, profits from these defensive positions can be redeployed into faster-growing industries, multiplying gains. Long-term success during recessions comes from identifying which industries will recover fastest. Historically, technology, transportation, digital services, and manufacturing lead the rebound. Governments often increase spending on infrastructure projects to stimulate employment, meaning construction and energy sectors accelerate quickly. People positioned in these industries, whether through skills, investments, or business ownership, benefit disproportionately during recovery phases. Recognizing these cycles early transforms an economic downturn into a strategic advantage. Another recession opportunity emerges from consumer debt patterns. During downturns, households struggle with credit card balances, mortgages, auto loans, and personal loans. This creates demand for restructuring services, refinancing advisors, budgeting platforms, and financial education tools. Entrepreneurs who build systems that help people manage money responsibly gain huge traction because the need is immediate and emotionally urgent. In a recession, people do not buy convenience. They buy security. Offering security is one of the most profitable business models during hard times. Recessions also reveal structural weaknesses in global supply chains. When goods become more expensive and delivery delays increase, companies search for local alternatives. Entrepreneurs who can deliver reliable, efficient solutions tap into fresh demand created purely by economic pressure. Domestic manufacturing, smart logistics, import replacement businesses, and digital tracking tools flourish in this environment. These are long-term opportunities with lasting value far beyond the recession. One of the most underestimated recession advantages is time. When job markets tighten and social life slows, individuals gain more hours daily. Instead of being consumed by an overscheduled routine, they suddenly have the capacity to pursue ideas, build skills, or launch side businesses. Recessions give people a chance to break from autopilot and rethink their path. Many life-changing financial transformations begin not with capital, but with time and clarity. The people who profit most during recessions avoid emotional decision-making. They do not chase quick gains or react out of fear. Instead, they operate with a mindset shaped by patience and strategic thinking. They accumulate cash before the downturn. They avoid unnecessary liabilities, and they position themselves for volatility. Every downturn in history has rewarded those who followed this disciplined approach. The individuals who panic, overspend, or borrow heavily right before a recession often suffer the most. But those who remain rational, focused, and prepared emerge stronger. Understanding how governments respond to recessions is also essential. Interest rate cuts, fiscal stimulus packages, quantitative easing, tax relief, and corporate bailouts reshape markets dramatically. Investors who anticipate these policies position themselves early in sectors that will benefit, such as banking, construction, renewable energy, or technology. Policy-driven growth can produce massive returns for those who move before the crowd recognizes the trend. But profiting from a recession doesn't require predicting government decisions. It requires observing economic fundamentals, employment patterns, inflation trends, currency movements, business inventories, and consumer savings rates. These indicators reveal where the economy is heading long before headlines announce it. Those who watch these trends understand when to save aggressively, when to buy discounted assets, and when to expand their businesses. History shows that wealth built during recessions lasts far longer than wealth accumulated during economic booms. Gains made in rising markets can disappear quickly, but assets purchased at deep discounts compound for decades. Businesses created to solve recession problems often become industry leaders when the economy recovers. Skills developed during hardship become the foundation for future income growth. For these reasons, recessions are not merely periods of survival, they are periods of acceleration for those who position themselves wisely. The second major profit driver in recessions comes from understanding capital flow. Large investors, hedge funds, and institutions reallocate money aggressively during downturns. They liquidate risky positions, move into safe assets, and prepare for rebounds. By tracking these flows through market data, commodity trends, bond yields, and institutional reports, individuals can identify where smart money is moving and follow the same patterns on a smaller scale. This strategy, known as shadow positioning, allows small investors to benefit from the research and expertise of large financial players without needing the same resources. Recessions also create opportunities for negotiation. When markets contract, sellers, landlords, employers, lenders, and vendors become far more flexible. Prices that seemed fixed suddenly become negotiable. Interest rates, rental agreements, job contracts, business partnerships, and even insurance terms can be revised. People who take advantage of this negotiation window lower their expenses dramatically and free capital for investments. This leverage disappears once the economy recovers, making recession timing a critical factor. In financial markets, recession-driven volatility creates enormous short-term trading opportunities. Not everyone should trade, but those with experience and discipline find these periods extremely profitable. Rapid price swings offer chances to enter and exit positions within days or even hours, capturing gains unavailable in stable markets. But this strategy requires knowledge, risk management, and emotional stability. Without them, volatility becomes dangerous rather than rewarding. The most important recession mindset is seeing the downturn not as an ending, but as a reset. Economic cycles exist because economies must rebalance. Excesses get removed, unsustainable business models collapse, and capital flows back into productive sectors. This reset is what fuels the next decade of growth. People who recognize this pattern remain calm when others panic. They understand that economic pain is temporary, but the opportunities created during downturns are permanent. During a recession, opportunities do not emerge in a dramatic burst. They grow quietly in the margins, in the spaces where fear distracts others from seeing what is actually happening. As the economic downturn deepens, the effects become visible in every corner of daily life. Companies shrinking their workforce, households reducing discretionary spending, investors dumping assets in panic, and entire industries struggling to adapt to a sudden loss of demand. But beneath the noise, new patterns form. These patterns reveal where future value is migrating, and anyone paying close attention can position themselves long before the majority realizes the shift. Asset prices continue to adjust as credit tightens, and consumer confidence drops to new lows. Investors who simply hold cash, waiting for markets to feel safe again, miss the truth. Markets recover long before the news becomes optimistic. While headlines still warn of layoffs, bankruptcies, and policy uncertainty, the foundations of recovery quietly take shape. In every recession in modern history, turning points arrived while public sentiment was still overwhelmingly negative. Understanding that emotional lag is key. To profit from a recession, decisions cannot follow emotions. They must follow indicators, valuation principles, and long-term structural trends. As businesses continue to cut costs, many high-quality companies become temporarily undervalued. These are firms with strong balance sheets, low debt burdens, consistent cash flow generation, and defensible competitive advantages. They are not immune to recessionary pain, but their ability to survive and recover makes them prime candidates for investment. When stock prices fall far below intrinsic value due to broad market panic, disciplined investors can accumulate ownership in companies they could never afford during boom times. The challenge is distinguishing between temporarily distressed firms and structurally failing ones. During recessions, both decline in price, but only one will recover. The key is identifying the difference. The recession also reshapes consumer behavior. When incomes shrink and job security fades, households shift from aspirations to essentials. Spending patterns reveal what people truly need versus what they can postpone. Sectors like luxury goods, high-end travel, and speculative technology often face massive contractions. Meanwhile, areas like healthcare, basic food production, discount retail, repair services, digital efficiency tools, and utilities prove remarkably resilient. This consumer shift creates opportunities for investors and entrepreneurs who align themselves with real demand rather than speculative trends. When people can no longer afford upgrades, they focus on maintenance. When they cut back on dining out, they increase grocery purchases. When budgets tighten, they seek cheaper alternatives. Understanding these shifts can uncover profitable ventures that thrive even in declining markets. Small businesses experience both the worst and best effects of economic downturns. Weakly structured small enterprises struggle to survive decreased spending, rising costs, and disruptions in supply chains. But well-prepared entrepreneurs or new entrants with lean models can step into gaps left by weaker competitors. During recessions, the cost of starting a business drops significantly. Rent declines as commercial spaces sit empty. Labor becomes more accessible. Marketing costs fall as companies reduce spending. In many industries, the barriers to entry shrink dramatically, creating an environment where strategic founders can build companies at a fraction of the pre-recession cost. Many of the world's largest companies, Airbnb, Uber, WhatsApp, Microsoft, Slack, originated or scaled rapidly during downturns. Economic chaos often accelerates innovation because consumers become more open to new, cost-saving solutions. Another major opportunity emerges in real estate. Recessions often push property owners, especially those with heavy mortgages, into distress. Housing inventory rises as individuals and companies try to offload properties they can no longer finance. Banks tighten lending but also prefer selling distressed assets rather than holding them. This combination creates price corrections that are rarely seen in stable periods. Investors with access to liquidity, or those who know how to leverage creative financing, can acquire properties below market value. Real estate downturns do not last forever. Population growth, housing demand, and inflation eventually restore higher valuations. Buying during the dip can produce long-term gains that outperform other asset classes. The key is avoiding over-leveraging and focusing on cash flow positive opportunities rather than speculative flipping. During this time, people begin to treat cash not just as a necessity, but as a strategic tool. Cash provides optionality when others are forced into liquidation. The ability to wait patiently, buy selectively, and avoid panic enables investors to make moves that simply aren't possible during booming economies. While many view recessions as periods of survival, experienced investors view them as seasons of accumulation. Even when economic indicators remain grim, the decision to act early based on fundamentals rather than sentiment becomes the foundation for profit. The debt markets reveal another layer of opportunity. As interest rates fluctuate and borrowers struggle, bonds, especially corporate bonds, can trade at deep discounts. High-quality companies facing temporary liquidity strains may issue debt with elevated yields. Investors who recognize which companies remain fundamentally strong can lock in unusually high returns. Distressed debt investing is riskier, but also highly profitable when done with precision. During a recession, entire portfolios of bonds may be mispriced due to market-wide fear rather than actual default risk. Investors who analyze credit strength rather than reacting to ratings downgrades can secure long-term income streams at attractive valuations. Technological transformation accelerates when economic pressure forces companies to innovate or disappear. Automation tools, AI-driven analytics, digital payments, cybersecurity solutions, and operational efficiency platforms experience rapid adoption. Businesses must reduce costs, optimize workflows, and serve customers with fewer resources. This is when technology companies offering efficiency, automation, or remote service infrastructure gain momentum. Investing early in these categories during recessionary conditions can lead to strong returns as adoption expands. What begins as a survival tool often becomes a standard operational requirement long after the recession ends. Global trade dynamics shift as well. Countries facing currency devaluation, export challenges, or supply chain disruptions may experience short-term instability, but they also reconfigure production in ways that open new opportunities. Investors who track these changes can identify emerging markets whose assets become temporarily undervalued due to local recessions, but hold long-term growth potential. Exchange rate fluctuations also create openings for those who understand currency cycles. Purchasing assets in countries whose currencies have been excessively discounted can generate outsized gains once stability returns. The labor market undergoes a dramatic transformation. As layoffs increase and job openings decline, skilled professionals seek alternative income sources. This surge of talent into freelance markets, consulting, and contract-based work creates opportunities for businesses that rely on flexible labor. Additionally, entrepreneurs can build teams at far lower costs than during economic expansions. Talent density increases as more experienced professionals become available, enabling new companies to structure strong foundational teams early in their development. This talent shift is one of the hidden advantages of recession-era entrepreneurship. As the recession progresses, behavioral economics plays a central role in shaping financial outcomes. Most people respond to downturns with fear, overreacting to short-term volatility. They sell assets at the bottom, hoard cash without strategy, avoid investments entirely, or seek guarantees that do not exist. Profiting from a recession requires avoiding emotional decision-making. Instead, it requires discipline, research-based conviction, and a focus on probabilities rather than narratives. Fear creates mispricing. Mispricing creates opportunity. The ability to trust data over panic becomes a competitive advantage. Another overlooked opportunity comes from industry consolidation. Large companies often acquire smaller, distressed competitors during recessions. These acquisitions enable rapid expansion at low cost, strengthening market dominance. Investors who identify which industries are likely to consolidate can position themselves early. Sectors such as energy, banking, telecommunications, transportation, and manufacturing often undergo major mergers during prolonged downturns. Buying shares in the stronger companies, those most likely to acquire rather than be acquired, can yield substantial long-term rewards. In the private markets, venture capital and startup funding change dramatically. While many investors pull back, the ones who remain demand stronger fundamentals, clearer revenue models, and realistic valuations. This environment reduces speculative hype and directs capital toward companies with genuine utility. For investors, this shift creates a more rational market environment. Instead of competing with inflated valuations driven by cheap credit, investors can negotiate terms that reflect real value. Early-stage investments during recessions often outperform boom-era investments because companies built under pressure develop discipline, cost awareness, and adaptability. On the personal finance side, individuals can use recessions to strengthen their long-term financial position. Debt restructuring becomes easier as lenders offer revised terms. Reassessing spending habits becomes a practical necessity, leading to improved budgeting and savings practices. Skill development increases as people pursue upskilling to remain competitive or change careers entirely. Many individuals transform their financial trajectories simply because the recession forced them to reevaluate their assumptions and habits. Tax strategies also present opportunities. Governments often introduce incentives, deductions, rebates, or subsidies to stimulate economic activity. Investors and businesses who understand these policies can significantly reduce costs and increase profitability. For entrepreneurs, economic stimulus programs can lower startup expenses or unlock grants and low-interest borrowing options. In the investment world, the concept of mean reversion becomes essential. Asset prices that fall excessively below historical norms tend to rebound when panic subsides. Investors who recognize these anomalies can enter positions that deliver substantial returns as markets normalize. This principle applies across equities, commodities, real estate, currencies, and even collectibles. Recessions create temporary distortions. Profits arise from anticipating the rebalancing that inevitably follows. Throughout the downturn, the most important advantage comes from understanding cycles. Economic cycles are not random. They follow patterns shaped by credit expansion, consumer confidence, production capacity, interest rates, and global trade. Recognizing where the economy stands within the cycle helps determine which strategies to use. Early in a recession, cash preservation matters. Midway through, accumulation becomes the priority. As recovery begins, scaling investments, expanding ventures, and locking in gains become the focus. Profiting from a recession requires aligning actions with each phase rather than reacting to headlines. The third phase of the recession reveals who adapted and who froze. Those who spent the downturn waiting for certainty find themselves behind, still fearful of making moves. Those who observed the shifts, studied the cycles, and acted with discipline position themselves ahead of the recovery. Once the economy stabilizes, the opportunities that were abundant during the downturn begin to close. Prices rise, competition returns, and the advantage shifts back to those with capital, not necessarily those with insight. Profit during a recession is never about luck. It is about preparation, patience, and the willingness to move against the current when the data, not sentiment, indicates the time is right. While most focus on surviving the present, those who look ahead strategically build the foundation for long-term prosperity. The third stage of the recession represents the turning point where decisions carry amplified consequences. The next phase will shift toward recovery positioning, where long-term gains are secured by acting before the rest of the market realizes that the storm is ending. Economic cycles always end in transition, and those transitions are where the biggest fortunes are quietly built. As the recession begins loosening its grip, signals of a turning tide appear, first not in headlines or government speeches, but in subtle patterns across markets, spending behavior, and industry sentiment. Investors who remain patient, data-driven, and strategically positioned are the ones who capitalize on this phase, because post-recession recoveries don't reward the loudest actors. They reward the most prepared. The first sign of recovery is stabilization. Prices stop falling aggressively, volatility softens, and markets behave in slower, more predictable waves. Businesses that survive the downturn begin adjusting operations for growth instead of defense. Hiring freezes, lift gradually, productivity rises, and credit conditions ease just enough to allow movement without overheating. From an investor's perspective, this phase offers a rare opportunity. Assets are still undervalued, but the risk of further collapse is significantly reduced. It is the window where markets remain discounted while confidence is rebuilding beneath the surface. Those who profited during the recession through steady accumulation are now positioned to amplify gains. Holding high-quality equities acquired at discounted prices becomes a powerful strategy when the recovery begins lifting valuations. Historically resilient sectors, technology, industrials, healthcare, and energy, move first. Companies that innovated during the downturn grow faster than those that merely survived. The priorities shift from capital preservation to strategic expansion, and institutions with strong balance sheets begin deploying cash aggressively. This period rewards long-term investors who understand that wealth compounds fastest when assets purchased at crisis lows rise into expansion cycles. Every recession in modern history has followed this pattern. Markets fall sharply, stagnate, and then rise beyond previous highs. The key is positioning before the upward momentum becomes obvious to the majority. By the time mainstream sentiment turns optimistic, most of the best buying opportunities have already passed. Real estate markets also enter a transformative phase. Properties purchased during peak fear now begin appreciating as interest rates stabilize and buyers return cautiously. Rental markets tighten due to delayed home buying activity, pushing income-producing properties into higher yield ranges. Investors who acquired real estate through foreclosures, distressed sellers, or discounted listings now benefit from both rental income and asset appreciation. Smart investors use this moment to refinance loans at improving rates, lock in long-term cash flow, and position their portfolios for the next decade of growth. Businesses born during the recession emerge as some of the most powerful players in the recovery. Companies that adapted through cost efficiency, innovation, or digital transformation operate leaner and smarter than their pre-recession competitors. These businesses often scale rapidly, attracting investors who watch them survive harsh economic conditions. Startups founded during uncertainty frequently outperform those launched in times of stability because they are built with discipline instead of excess. Corporate M&A activity accelerates as well. Strong companies acquire struggling competitors at attractive valuations, consolidating markets and expanding their influence. Investors positioned in these acquiring companies benefit from explosive growth as cost synergies, market share, and operational efficiency push profits higher. These cycles recreate industry leaders and set new standards for competitive landscapes. For individuals seeking to profit during this stage, the strategy is clear: follow capital flow, not headlines. When institutional investors begin allocating funds into recovery assets, they leave clear footprints. Volume increases gradually, bond yields settle into predictable patterns, and equities begin forming higher lows instead of lower lows. These signals tell disciplined investors that momentum is changing direction, providing cues for increased exposure to risk-based assets. Side business creation also becomes more profitable during this period. As consumer spending rebounds, demand for services expands, and digital markets continue accelerating, small enterprises formed with minimal capital begin scaling. Recession-starting businesses often benefit from lower operating costs, highly skilled labor available at more competitive rates, and untapped gaps left by companies that failed. Automated systems, online marketplaces, remote work models, and subscription services gain traction as consumers seek convenience, affordability, and reliability. However, one principle remains constant. Sustainable wealth comes not from predicting the exact bottom or top, but from disciplined participation throughout the cycle. Recessions reward those who act while others hesitate. Recoveries reward those who hold and build instead of rushing to exit. Overtrading becomes a liability in this phase. Investors who maintain conviction in their long-term theses outperform those who panic at every pullback. As the recovery strengthens, inflation moderates, employment stabilizes, and global confidence rises, central banks adjust policies to balance growth without overheating. Governments introduce reforms, infrastructure investments, and support programs designed to stimulate long-term expansion. While these shifts create optimism, they also introduce new risks that investors must navigate carefully. Excessive debt accumulated during the recession can strain economies, asset bubbles can form quickly during recoveries, and geopolitical events can disrupt markets without warning. But for those who maintain grounded strategies, the post-recession expansion becomes a period of extraordinary opportunity. Investments made during downturns often multiply several times over during the following years. Wealth generated in these cycles forms the foundation for financial freedom, business expansion, and long-term security. The path forward demands discipline. Continue dollar cost averaging into strong assets, diversify internationally, avoid emotional decisions, and stay focused on fundamentals. Recessions and recoveries are natural components of the economic cycle, and each phase provides unique opportunities for those who understand how to navigate them. Profit does not come from fear or speculation. It comes from preparation, patience, and strategic execution. As the global economy transitions into renewed growth, individuals who use the recession as a period of learning, investing, building skills, and expanding assets emerge significantly ahead. Their choices during the downturn shape their success during the upturn, proving that recessions are not merely economic declines, but powerful gateways to wealth creation for those who understand their mechanics. The recovery, like the downturn before it, reshapes industries, technologies, and societies. It creates new winners and new systems of value. And for those who moved strategically, the recession becomes not a period of loss, but a defining chapter in their financial evolution, one that establishes resilience, wisdom, and a strong foundation for decades to come.